Today's market call is presented by FactSet, financial data and analytics powered by tomorrow. It's Tuesday, the 13th of May, 11 a.m. on the East Coast. Swizz here with Dan Nathan. How are you, Dan?
I'm doing great, guys. It's great to have you back on the market.
Well, I don't know if that's true.
On the earlier pod, you were missed. I think people get sick of my voice. I'm just going to say that right out of the gate here.
Doubtful, but it's, sometimes it's good to be away. You clear your head, you get a different perspective on things. Not that my views have changed all that much, but you get to look at things from it. You're not basically at ground level. You're not in the shit, as they say. You can look at things from 30,000 feet and maybe get a different perspective. With that said, Amanda made a great first slide, and there are a lot of people that are getting a bit of a different perspective on the heels of what we've seen over the last few days. So you have David Kostin, you have different people raising their price targets. Somebody like Ed Yardeni cuts his recession outlook, and a lot of people are, again, trading and investing and markets and macro. It's a living, breathing thing. So you reserve the right to change your mind, and things are fluid. But it's interesting on this Tuesday, the 13th, to see that people on the back of this 90-day basically reprieve and potential for a deal are recalibrating, I guess is the word.
Yeah, I mean, listen, the hard part about a strategist is that your expectation from the house in which you work for, the investment house, right, is that you're trying to be as accurate as possible. You're looking out into the future. You're using the data points that you have available. We've talked about this a lot also, that a lot of these folks seem to cluster around certain things. Why? That's kind of the safest way to be. A lot of people don't want to be outliers in this sort of thing. It's kind of, protection or some sort of, job security, I guess you will. I don't know if this is that helpful, like in the last 6 weeks or so, to have, chasing this way and that way. And, there were a few companies that gave guidance guy right out of the gate. Maybe the Fed did this a little bit, talking about base case scenarios, worst case scenarios, best case scenarios, that sort of thing. And, I think the strategists who came out, the companies that came out and did that, I think it was probably the smartest way to do it, rather than try to pinpoint, Torsten Slok from Apollo, I think a few weeks ago, was out with a 90%, recession probability. Now, let me ask you this. He had a lot of caveats on that. You know what I mean? If this, that, and the other thing happen or don't happen, then there's a 90% probability of a recession by the summer. When you hear something like that, you've been, in the business for a long time, on the institutional side. You talk to a lot of retail investors now through Fast Money, through our pods. Is that useful? You know what I'm saying? To kind of track what those folks are saying and kind of invest or trade in line with that sort of sentiment?
Yeah, that's a great question. I think it's useful in so much as these are people you want to hear what they have to say, but it's not useful in so much as you're really not going to make trading decisions, I don't think, based on those prognostications. So I always think it's helpful to hear what people have to say. And on our earlier podcast today, we mentioned Paul Tudor Jones and his appearance on CNBC last week, so we won't go through it again. But there's certain people that speak. You want to listen to what they're saying, what their thoughts are. But go back to that slide real quick, because I don't know if we can blow it up. But if you look at the far right as your eye looks, and the implied price to earnings ratio on the back of these forecasts, everything is north of, I want to say, 20.5. I think it tops out around 26 or so, and the mean is probably somewhere between 22.5 and 23. And that's me doing just back of the envelope math. I only bring that up because that is still, and this, and I think our listeners and viewers know this, that is still a very high multiple on any, in any landscape, not least of which I think the landscape that we find ourselves now. So you really have to be optimistic, and you really have to believe the market is be willing to pay a premium in order to get to those multiples, in order to get to those price targets.
Yeah, no doubt. It's interesting, Guy. Yesterday, you were not here, obviously, for the market call. Supposedly, Amanda said to me, or maybe CC, it was like there was a lot of new people or a lot of folks in the chat. They were kind of dogging me. Well, Dan's this, that, Dan's that, this. Now, I can tell you fairly certain as the shirt that you're wearing is
Salmon. Oh, it is linen. Yeah, it's
a
definitely linen.
linen salmon. Oh, there it is.
Where
Thank
did
you,
guy
Jay.
get the shirt?
Where did guy get that
Hold on a
shirt?
second. I mean, if you really want, I can hold
No,
on.
you
Bear
can't
with me a
do that.
second. No, I mean, I can do a lot of things.
I don't know how
Like,
you're gonna turn that thing around, even if
no, I
you
want
take
to see what maybe I don't know if Amanda can.
take a screenshot, somebody, and
Amanda's somebody's. I'm sorry. I
yeah,
apologize.
Amanda just said, "Oh my."
You just said. I
As
apologize.
certain as that shirt is salmon linen, which is beautiful, and you just did get back from the Keys, so you're still feeling it a little bit. You know, listen. All right, let's just break this down for a second. From the February 19th high, let's pull up the S&P chart, okay, to the lows that we saw
Right.
on
April 2nd, 3rd. Right.
yeah, April 7th. I think that was the low, and it was a panic day. We were down 21.5%. That was, technically a bear market. Okay. So now, Amanda, if you could go, this is a static chart, I think. Go back to like 2022 for a second. All right. So we've talked about this for 3 years, that was a very orderly bear market. I don't think we had any panics that looked like that. I don't think we had a single period where the VIX went 50 or anything like that, where gold was making new highs, right? So you look at that sell-off, and there were some big rallies in that. And I don't think either one of us, 2 Mondays ago, maybe, when the market, it was still dicey, who knew what was going to happen? You're not pressing lows. You said 57.50. That's where you thought. I was very bearish on the economic potential, less so about the markets down there. And I guess the point I'm trying to make is 2022 versus what just happened. We did basically most of what we did over the course of a year in late 21 to 2022 in a month, right? So what's certain these days? The certainness is that if you drop that hard that quickly, you're going to get a V reversal, right? And look at the recovery from the highs in 21. It took 2 years to get, you know what I mean? Get back to those highs. So I guess if it happens all at once, then sometimes you get it all back at once, but that doesn't mean we're out of the woods.
I don't think we're out of the woods, and I don't think there's really a valuation cushion to support this market. And again, if Amanda wants to sort of do, by the way, Amanda is great. If she wants to throw a 50-day moving average on top of this and take a look at where things stand, I mean, you still have that. Now, look, when that cross happened, that actually wound up to be the best time to buy stocks because it happened in early April. But it's still in place, and you can zoom into this thing and see. We have absolutely gone through the 200-day, but what are we setting up for here? I mean, are we setting up for a little bit of a short-term blow off top? And, I think the rest of today, I think it's going to be something to watch in terms of, do we reverse and do we sort of give back some of the gains, the S&P? Because if we do, and if you have a VIX now that's 17.5, 18, now you could be looking at a trough VIX and maybe the height of optimism in terms of the S&P 500. So I do think the rest of the day is worth watching for sure, Nathan.
All right. So let's go to the data, because right now I could actually see companies, Guy, that either pulled their guidance, gave conservative guidance, right? Or, just talked about the lack of visibility. Might you see these companies, or guided down, might you see these companies pre-announce? As we get into, let's say, towards June, and we're 2/3 through the quarter, if they say, we believe the worst is behind us because we're now factoring in, at worst case, 30% Chinese tariffs. Now, let's not forget, we don't have a deal with the EU. We don't have Canada, and we don't have Mexico. You put Canada and Mexico together, they're like 2.5x the trading that we do with China. And I think the deficit is greater, like far greater. So I think that the China thing is one thing. I think our allies are another. I think the way that, the White House is trying to bully Canada doesn't make them more inclined. I don't know if you saw any of the tape of the Mark Carney meeting.
I was around for that. It was earlier last week. Yeah.
It didn't go as badly as the Zelensky thing did in February, but I don't think it went that well for Trump. I think there was a clear shot across the bow that, we're not going to just, get down on our knees and kiss the ring, that sort of thing. So again, those are the worst case scenarios, but again, not the worst case scenarios. Those are scenarios where if we don't have progress with our allies, you might have a continued uncertainty. But my question for you is, Guy, let's just say all the data that we get over from the last month, you throw it out. I mean, it's backward looking, right? And what sort of data would you have to get in the next month or so where the Fed, as we get closer to that June 20 or June 18th meeting, we might see the CME Fed funds tracker move more likely, not June, but July? Because right now it's like 65-35, I think, that sort of thing.
Yeah.
Because, and then my question for you is, if we start getting signals that the Fed is getting more comfortable with lowering Fed funds, is that good for stocks?
There's a lot. There's a lot there, so I'll try to unwrap it layer by layer. I think the Fed, with the data we've been getting, suggests they should sort of hold the line here. Now, people will say, wait, if inflation is coming down, why don't they start to lower rates so maybe we'll free up the mortgage and housing market and those types of things? I mean, there's that school of thought. I've heard a lot of people talk about it. The flip side of that coin is, if it ain't broke, don't fix it. And things are going pretty well here in an environment where they've sort of stayed the course. As much as people want them to lower, it's not like it's been hurting in any significant way. And again, why try to, or why allow that inflation genie back out of the bottle if you seemingly have it tamped down right now? But the thing, the data, I think that's going to matter most, and you can talk about all different types of things. I think the one thing they're focused on more than anything is the job market, the labor market. And again, it appears to be going pretty well on the labor front. Things aren't as good as they were, let's say, 6 or 9 months ago, but they haven't fallen off the cliff. But if you're to start to see some weakness in the labor market, that's going to concern them. Now, with that said, and I don't know if Amanda can pull this up, but over the last half hour, 45 minutes, you get some announcements from Microsoft, and maybe this is just run-of-the-mill typical stuff, but they announced some layoffs as well. And more, you're starting to see companies announcing these layoffs for a myriad of different reasons. And I'm not trying to sound the alarms here, but I do think the labor market is something you have to continue to watch, because I'm not as optimistic as most people, I think, on that front.
All right. So I got to ask you about this on the hiring front. Okay. I saw this headline yesterday and I immediately went to see how many people this company employs. McDonald's, they employ 150,000 people. That's globally. The headline yesterday is that McDonald's sets goal of hiring 375,000 U.S. workers this summer. How is that possible?
Is that right? I mean, I didn't see that. I was on a plane.
Amanda, pull that up. Okay.
I believe you, by the way. But
McDonald's said 2023 that it would open 900 U.S. locations over the following 4 years. Roughly 800,000 people work at McDonald's restaurants. Okay. All right. So that must be corporate, 150,000 people. About 95% of the chains, more than 13,500 U.S. locations, are franchised, okay, meaning they're run independently. The hiring announcement follows disappointing first quarter for McDonald's. I mean, if they literally, 2 years ago had 800,000 workers, how the hell do you hire 50% of that just for the summer?
I'd have to dig deep into that, but there's obviously some caveats on this. So
I wasn't trying to stump you. I'm just saying, like, that just doesn't make any sense, right? Like, so I just think there's a lot of stuff like that. The government hiring obviously is slowing down a great deal. So when you talk about, the employment situation here, it's okay. I mean, I'm glad it's okay. You're glad it's okay. We don't want to see anything fall off a cliff, that sort of thing. But I think to your point is that the stock market, since the lows in 2022, when inflation was at its highs a few months earlier, when Fed funds rate was, going from 0 to 2.5, then on its way to 5.5. I don't know where they were when inflation was at its highs. Stock market did pretty well in 2024. You know what I mean? So to your point, I think that if the data is kind of hanging in there and the rate is not that restrictive, why don't you save the cuts for a rainy day, I guess?
Save your bullets. I agree. I mean, that's what I would listen. I'm not the Fed chair, and obviously I'm not under the pressure that this current Fed chair is as well. And there's a laundry list of people, obviously, that want rates to be lower for some maybe the right reasons. I think some for sort of politically expedient reasons that in the long term don't help anybody, but in the short term clearly do. So let's see how it plays out. But with that said, we should take a look at the bond market, because a couple weeks ago, it's more than a couple weeks ago now, it's a few weeks ago, there was that event overnight where the bond market was absolutely imploding. And I think that's what scared the administration. And rates traded higher in a pretty meaningful way. And then, they did some things to assuage your concerns and rates traded back down. Well, here we are, Dan, once again, pushing towards, this is the TLT chart, and you can put up a yield chart. They're going to look inverse, but you see what I'm looking at here. Where if you want to make that trend line, we're pretty critical levels here in terms of yields potentially breaking out to the upside. But more importantly, I think, is the TLT chart. And you go back a couple of years, you get down around 82 in the TLT, and you're looking at levels we haven't seen in quite some time. And I've said it for a while. I'll say it again. There's no real meaningful bounce here in the TLT, and I remain one of the few people out there. And again, I've been wrong so many times it's hard to count, but that think yields are going to go higher and surprise people. By the way, you spoke to Peter Bookvar yesterday. I think that's going to drop tomorrow. I think he's in the camp that we're going to see 5% again in 10-year yields, and I'm hard pressed to believe that's going to be market positive.
Yeah. Our main man, Doug Cass, over there at Seabreeze Partners, thestreetpro.com, writes, he had a great note out this morning. I can't find my way home.
That's a traffic song. Maybe it was, I think it was Traffic, but that's Steve Winwood, who I think his birthday is today, if I'm not mistaken.
Also, it was on the famed album EC Was Here, by Eric Clapton, obviously played on that too and sings on that song. But Doug goes through this whole idea of rethinking American exceptionalism. I know this is something that we talked about. We saw the way treasuries were sold. We saw the way the dollar was sold. We saw the way that, some of the biggest stocks in our market were sold. This was obviously going back a month ago, but the way that they were buying gold, right? And so that sort of thing, it kind of speaks to everything that he's talking about. But Doug had a little trivia here too, Guy, which I thought was really interesting. He said, name in correct order Eric Clapton's bands, and he's just going to throw this out here. And
wow.
That you're not a huge Clapton aficionado. I know that during one of the breaks last night in Fast Money, which you were not on, there was a song from No Alibis from Journeyman.
That's from Journeyman.
Yeah. And I looked up at Tim, and obviously if you were there, you would be like, and Tim's like,
that's on my playlist.
He thinks
it's absolutely on my playlist.
So he just thinks that EC is very overrated, which I thought was interesting.
No, he's not. So he was part of a band called Delaney and Bonnie, if I'm not mistaken. He was part of John Mayall and the Blues Breakers. He was clearly in the Yardbirds. Blind Faith had, I think, 2 albums, if I'm not mistaken. Yeah. Derek and the Dominoes. Yeah. That was a band that did Layla, obviously. By the way, Dwayne Allman was in that band.
Wow. Okay.
And Cream was like one of the first super groups. I think I got them all. Is that pretty
all
good?
Right, you did. And Doug said next to Delaney and Bonnie, I bet he will miss this one. Okay, so you didn't miss it.
No, I know. Yes,
we've talked about this. Doug and you have these crazy memories, but he wanted you to kind of put him in order. I think that would be nearly impossible.
I didn't think I got him in the right order, but I can't.
Pretty. You want my guess? I would say Yardbirds, Delaney and Bonnie, Derek and the Dominoes. I have no idea about the John Mayall Blues Break. That's probably really early. And then I would say Blind Faith and then Cream. That's my guess.
Look at you. Cream, Ginger Baker. It was in Cream. I can't
just saying. Listen, we have a hard out at 11.
I apologize. Let's continue to go.
I did it. All right, pull up that 10-year chart that we did with the downtrend and then that kind of 415 level. If you want to take out that little move that we had lower. So I guess my question to you, and going back to a 5% 10-year yield, Guy, we break above this thing. We're on our way to 475 early this year. The stock market didn't mind at 475.
No, it didn't.
Year. It was very near its highs. So it's not a slam dunk that if we go to 475, 5%, that the S&P has to careen lower. No. So for whatever that's worth,
it's not a slam dunk, and it's obviously the way that it gets there as well. And the move that we saw a couple of weeks ago was the bond market was breaking. And I don't want to be hyperbolic here, but it clearly was. There was something going on that really frightened a lot of people. And listen, rightly so. Now it's moving in an orderly way. And what I said that day in the aftermath, I thought that might have been a tremor, and there might still be some pain coming in. And it appears as though that's what's going on right now. And that Carter will say correctly that, you know what, we've been here before. People make way too much out of the rate move and where rates are. By the way, I think Jamie Dimon has said similar, but it's what the bond market, I think, is sort of telling you. So if you were to see a continued rise in yields here, and I do think we're going to see that. And if we see a real acceleration to the downside in the U.S. dollar, which again I think we will we will see, that's something that I think should be concerning. And that's something that a couple of weeks ago on the weekend shows Janet Yellen was talking about, and a lot of other people in the markets started talking about something they haven't seen before, this rising yields, lower dollar. What does it mean? And I don't think we're out of those woods by any stretch of imagination.
Yeah. Are you an Ayn Rand fan guy? Did you ever read The Fountainhead?
The Fountainhead. Yeah, I mean, yes,
What's the
that
other one?
is, I mean,
By
it's
the way,
pretty amazing.
I love that book. But people who say they love that book now sometimes take some. Are you an Ayn or
Atlas,
Ant?
Atlas,
Atlas Shrugged.
Atlas Shrugged.
That
Is the other
book
one.
kind of sucked. It was basically the same premise as the Fountainhead, which I actually did enjoy. But Doug has this quote, which you probably heard before on his note this morning. You can ignore reality, but you cannot ignore the consequences of ignoring reality. So again,
Well, you know,
that's reality. But
well, that's what you're basically saying is, you know, you could shove your head in, like you can be an ostrich and you can shove your head in the sand and not pay attention to it, but doesn't mean the reality isn't out there and the consequences aren't coming. And it's true. And listen, when the market is making 1,000-point move in the S&P over the course of a month to the upside is a pretty significant move. And I think that has a way of changing the opinions or changing sort of the outlooks, but nothing, in my opinion, other than some of the optimism around trade, which is still a huge question mark, nothing's really changed all that much. Again, that's just my opinion. People say you're missing the boat. Yeah, maybe it won't be the first time, but you know, all the concerns that I had prior are still there. They have not gone away. The only thing that's changed is the market.
Yeah, let's pull up the US dollar index, the Dixie, for a second. And you know, this is one that's not going to look, you know, that $100 level when it broke to the downside. You know, if you look at it on a 5-year basis, if you just want to pull that out for a second, you know, that was important support going back a couple years, that it just kind of broke through. You think about the 110 to sort of 99 sort of move. That's a massive move. But don't forget, you saw what happened in 21 when the stock market was much lower and how high it got into late 22, a pretty remarkable move in and of itself. Does the dollar move, Guy, you know, now that we're back above 100, does that look fairly stable to you? And can you see a move back to the 200-day moving average, which is flat-ish? It did turn down, but towards 104. And is it important in general right now?
I think the dollar is destined to continue to go lower. I think, to your point, you could see it maybe a look at or trace back up to the 200-day moving average. I think any rally in the dollar is going to be short-lived. I think there's something fundamental going on with the dollar. I spoke to Mike Novogratz, I think it was last week or a week and a half. I think it was last week, and he had the same view about the dollar. He thought the dollar was probably destined to go lower. He thought dollar yen could get as low as 130. So I think the dollar move is something to watch. And I don't think a lower dollar is painting a particularly rosy picture, especially, as I said earlier, if on the back of that you see yields go higher, which I do think there's going to be a continuation of that theme. And you know, the stock market's going to have to figure that out. And I think more importantly, the macro communities have to figure out what does that mean. And to a certain extent, and you talked about American exceptionalism and, you know, people wanting to be in our markets and in our assets. You know, I think that bloom is off the rose a little bit, despite what you've heard over the last 48 or 76 hours.
Yeah, no doubt about that. Let's look at Bitcoin for a second, because we had been highlighting the fact that Bitcoin had really underperformed gold for a while, and then it seems like that has kind of you know, gotten back towards those prior all-time highs. It is interesting if you want to back that out again, Amanda, for a couple of years or so. We've talked a lot about this with Bitcoin. You know, it can go sideways, it can trend lower. You know, it was doing that for a lot of last year after that early ramp, and you see that breakout. Obviously, that had to do with post-election sort of stuff, but it retraced that entire move. We thought it could do that below its 200-day moving average, and now here we are back towards those highs. You know, again, I have no idea what would help this thing establish a new range. I mean, but it is a particularly interesting level, in my opinion.
I agree. And either going to go blowing through here, or we're going to fail at these prior highs and have a look back at the 200-day moving average, which, again, I'm not a Bitcoin expert. I'm surprised by this move. There's a lot of optimism, obviously, around crypto over the last week and a half or 2 weeks. I'm not really sure what it's on the back of, quite frankly, but here we are. If you think about it, as gold was making the move higher, Bitcoin should have been moving in tandem, and it wasn't. So there was some sort of risk-off thing going on in Bitcoin, maybe on the back of technology stocks. And maybe it's as simple as the NASDAQ goes, Bitcoin goes. And I think, you know, maybe there's a part of that as well. But I don't know. It just feels like you better get through 110 on the upside. Otherwise, I think there's an inevitability that you're going to see the 200-day moving average. But that's just me. Real quick, we do have some interesting questions here, Dan. Give me a second. This is from David Clark, and he's saying, how are you guys positioned for the long-term retirement? Well, my retirement is probably a lot closer than most of the people watching this thing. But what we say all the time is, and this is important, you know, there's a trading aspect to what we talk about, and there's an investing aspect. And the investing side of the equation, setting up for your retirement and all those things, I mean, that's just sort of like, you know, set it and forget it. And you've said this 1,000 times over the years. You know, there's an aspect of that. What we're trying to do on a day-to-day basis is try to look at sort of the trading landscape and how to navigate. But when you're looking at things over the course of 5, 10, 15, 30 years, well, a lot of what we talk about respectfully is just sort of background noise. Now you say, well, then why should we listen to you? Because there are people that enjoy the markets on a day-to-day basis and are trying to navigate the markets on a day-to-day basis. But for most people that are looking for a retirement, if you're in the 20s, 30s, don't get caught up in the noise that we talk about. Don't get caught up in the day-to-day stuff. You know, focus on the end goal. And historically, if you do that, you're going to be pretty well suited, Dan.
Yeah, and that's a great, I mean, the point about separating the forest for the trees, right? So there's this kind of idea that you set it and forget it, as you just mentioned. And that could be, I think most importantly, I think if you are, let's say in your late 20s, you really have to start leaning into a 401k that's offered at your company, if you are so lucky to have that, an IRA, you know, that you can do alongside that. If you are self-employed, you could look into a SEP IRA, right? And the idea of compounding interest over a long period of time. If you are 25 years old, and just think of this, you can't take your money out of, you can, but with penalties, out of a 401k or an IRA or a SEP IRA, that sort of thing. And let's just say you have to start taking, this is the way it works, withdrawals at 65, and there's a certain amount over years. But think about if the stock market is meant to, let's say, double every whatever, you know what I mean, like 10, 15 years or something like that. And you have the compounding, the power of compounding interest in a tax advantaged account from 25 to 65, you know, put a calculator in there. Think about how much you would be maxing out and that sort of thing. And it's hard to kind of project that. You don't know income levels and excess sort of thing. And then the other one would be 529. I mean, as soon as you have a kid, you can start doing that too. So those are all things that make a lot of sense. Because, like, for instance, I'm 52 years old. I have 2 kids in college. You know what I mean? You can start planning, mapping that stuff out too. So as far as retirement, I know this is not something that we do is, you know, financial planning, but I think those are some core tenets, Guy, of doing that. So thank you for the question.
Yeah, let's move quick here. I mean, there are a couple of things we have to look at. NVIDIA is one of them because we drew a trend line. And, you know, we've talked about this downtrend that NVIDIA has been in. And obviously it traded down to basically the August lows. We thought it could, it did, and it's bounced. So here's the question. Is this downtrend broken enough where you can have a continuation, or is this just a bit of a false breakout? Obviously, we're going to know a lot more when they report earnings. I'm sort of in the false breakout mode camp, but obviously there's some news that is supportive of what's going on.
Yeah, I mean, the news went from so great a year ago to really lackluster. You see that the thing just kind of went sideways for, you know, the better part of the last, you know, 9 months or so prior to it breaking down just about a month and a half ago. And then the news flows got really bad. It started in late January. You see that gap. It was DeepSeek. And then it was just kind of, you know, the stock wasn't going higher when some of its biggest customers were raising their CapEx. I think that was an interesting tell. The valuation got really inexpensive, sub 20, you know, PE, yet it's had a, you know, a valuation price to sales that was like teens or something like that. So it all depends how you look at it. I'm not buying the breakout. I see a flat 200-day moving average. Let's see if it were to kind of retrace that downtrend, go back through the 200-day moving average. Obviously, their earnings about a week and a half are going to be a really important one.
Real quick, Palantir question from Clark Kemp, if you want to throw it up. I know we have to get out of here. We're on a clock today, so I apologize. I'm trying to get to everything. But the question basically is, should I buy puts, September puts in Palantir to protect my long position? Want to believe the company will do $10 billion a year in revenue in time. In my opinion, in order to justify the valuation that they're currently trading at in price to sales, it's got to do a lot more than 10 billion, but that is a start. I can't speak to the options, Dan. You probably have it in front of you. My sense is they're probably really expensive at this point. I mean, I'm more inclined to do this. You know, you long the stock, you obviously have a view. just sort of on the way up, play a little stock market here, take 20, 15, 20% off and trade around the edges against a long position. I think that's a better way to do it than try to buy puts that are probably going to be very expensive that, as you know, there's a very good chance to expire worthless. So I'm more inclined to say trade against your long position. Let strength be your guide, and use the moves that we've seen to your advantage. But that's just me, Dan.
Yeah, so I'm just looking at June expiration really quickly, and with the stock at, let's say, 127, the 125 put in June. Okay, so that's out a little more than a month, are offered at $9.50. If you just kind of look at that, that's about 7.5% of the underlying stock price. It breaks even below that. So it's a 10%. Loss before you get stopped out of that position, you know what I mean, in June expiration. So really hard way to do it. I think what Guy, suggests is like, listen, if you're a true believer and you think they're going to get $10 billion at the end of next year, and that, halves the price to sales multiple or more than that, and you think, it's going to grow in from a PE, listen, it's been a bad move to sell this stock. You know what I mean? Like, it was trading $20 a year ago. Now it's 126, but you had to really absorb a shit ton of volatility. Again, I still think this is the dumbest fucking stock in the market, but have a ball. Really quickly, Guy, UNH, let's talk about this one for a second, because the stock has literally been cut in half in a month and a half. And today their CEO is leaving, a whole host of things under his, under his tenure, that huge data leak. They've had, obviously very sadly, one of their, major executives was killed. That shed some light on some of the practices there, you know what I mean, from coverage and the like. The stock now, they had a missed result, huge gap. CEO's leaving. They pull forward guidance, cut in half. You tell me, like, is this presenting an opportunity? I know you're kind of looking into the abyss here, but it could be kind of an interesting one, possibly.
Well, I'll say this. If you look, we had that huge leg down in mid-April. I think the stock went from 600 down to 4.25. And then you'd be like, okay, maybe that's your opportunity. Well, the stock traded sideways to lower, and now you're seeing another leg lower in the stock. So I don't think so yet. And I understand people are going to point to valuation and stuff, but man, oh man, so many self-inflicted wounds here, number one. And number two, the backdrop that they live in is not particularly good either. So I don't know what the volume is yet today, Dan. You could probably look. I think the average volume for the stock is 9 million shares or so a day. I'm sure it's traded probably 2 times that. Yeah, there you go. So by the end of the day, maybe we'll trade 4 times normal volume, but this is crazy to say, but I don't think you've seen a capitulation yet in the name.
Yeah. And again, that's a great example of just kind of looking at something on a price basis and just saying, hey, this thing looks washed out. The news couldn't get any worse, that sort of thing. And maybe this is an opportunity, but you got to factor in a whole host of things. I don't think the techno of Amanda wants to pull a 5-year. There's nothing that's going to help you there. You've had a flat 200-day moving average, but like all these things, Guy, at some point, Boeing's a great example. The news flow, they haven't had a good headline in like 4 or 5 years, you know what I mean? But sooner or later, things get washed out.
Took a long time for Boeing, though, and we'll talk about that on the next market call. This is a busy week for us, so I apologize. But, you're right. But it takes a lot longer than people think to sort of sort itself out.
All right. We got Peter Vilkar dropping in the RRP. That's the Risk Reversal Podcast store, or the feed. That's tomorrow morning. You and I are going to be back with some market calls later on in the week. Lots of great content here, people. So thanks for being here, Guy. I love your linen salmon. We'll see you all tomorrow. Thanks. Bye.